Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of LME 3-month nickel, zinc and tin.
LME 3-month nickel. The most significant feature of this market in recent weeks has been and still is the very significant lows of 2021 at 15,665, which led to the lows of late November 23, plus this year in January, February, and with some mild finessing, the lows of late July and early September in the 15,840 and 15,600 zone, and now in late October and the last few weeks as well. It is at this point that I feel obliged once again to mention the big descending scallop pattern I've been going on about for months now, what it may mean within the near-term universe. So the key level has been and is the lows at 15,840. A significant move below this, and by that I mean you would know it when you see it. A significant break below this would give a downside potential for the descending scallop pattern in the 13,830 zone. It still all comes down to what the market has done and even now might still do with that 15,840 zone. First time around in late July, prices chose to bounce back upwards, and during the start of August sustained the bounce. However, over mid-August, prices had an issue with testing the June 2021 low at 17,095, and I suspect indirectly the now flatlining gold long moving average, currently at 17,330. This suspicion eventually evolved into a mid-July to early September ascending wedge pattern. Then early 13 weeks ago, prices broke down through the base of the ascending wedge pattern, easily reaching the primary target and close enough to the secondary target for me to choose not to designate it. However, the market then built up again, but then once again punched lower, through the May 2021 low at 16,610 and into a fairly free area until we once again reached that key level, the 15,840 level 5 weeks ago. But once more we saw prices pull back up again. The following week only to run into the brick wall overhead, consisting of a combination of the now flatlining green short medium moving average, currently at 16,545, and the mauve medium moving average, currently at 16,440, as well as the nearby May 2021 low at 16,610, thus turning back down and eyeing once again the 15,840 zone below. Over the middle of November, up to and including today, we have variously been both above and below this key 15,840 level. The market is teasing us all, as there has not been no definitive reversal back up nor significant break lower. The only feature I've added today has been a dark blue prospective neckline, currently at 15,780. It's not that too far away. 15,780 for a possible July to date head and shoulders pattern. I do not have great confidence in this pattern, but it is not only pretty scrappy as a pattern, but is also in the wrong place at the lows of the market. However, it is a possibility, and I felt obliged to notify you of such a possible pattern, especially as the neckline is so close and approaching the important 15,840 lows. LME 3-month zinc. 13 weeks ago, prices drove higher, prompted by a small late July to mid-August reverse head and shoulders pattern, up over the June 2021 low at 28.10, over the broken old dark blue upper time, currently at 28.75, of the May to August 23 bullish shift pitchfork, that subsequently acted as an August 23 to April 24 upper bull channel line, then over the green short medium moving average, currently at 30.54, the mauve medium moving average, currently 29.24, a congestion band between 28.58 to 29.65, containing the April 2019 high at 29.59 and the 50% Fibonacci of the big old 2008 to 2022 move at 29.65, plus further up the green middle time, currently at 31.09 of the February to August bullish shift pitchfork, as well as over the July high at 30.22, followed by the bright red neckline extension of the September 20 to December 2022 reverse head and shoulders pattern, currently at 31.35, where the market finally slowed down and took a breather during early October, and then again over late October, just shy of the June 2018 high at 32.20. I said of this move up 8 weeks ago, and I quote, "Prices have moved higher still to now test what I suppose is the holy grail of this market, the neckline of the September to December 2022 reverse head and shoulders pattern. This could become a seminal moment, so watch carefully." End of quote. Well, what looked like a double top over October, after what looked like a double top over October, prices headed lower, below the green middle time and the green short medium moving average, the congestion band between 29.58 to 29.65, the mauve medium moving average, but, and it is an important but got stuck at the old dark blue upper time that became an upper bull channel line. A broken pattern, or patterns if you like, but one that is still highly influential. It really all came down to what I said 8 weeks ago when I said, and I quote, "The question now is whether the market will falter here much as it did in late May, or will it really go for the higher price?" End of quote. I added this to my words of 4 weeks ago when I said, and I quote, "Keep a careful watch on the 29.40 zone below and what may or may not happen at and over the neckline above." End of quote. Over the past 3 weeks, we have seen prices test down once again, down to the 29.40 zone, and fight shy of fully testing the mauve medium moving average below, as well as avoiding the dark blue upper time below it. Though tested in recent days, there is not a single close below the mauve medium moving average, and thus it was no real surprise to see prices turn and move back up. Now, these past 2 weeks, prices moved up and away from the key 29.40 level, up through the green short medium moving average, now seemingly using it as a dynamic base, and up to test the green middle time and the lesser Fibonacci line at 31.03. Above this is the important red neckline extension, currently at 31.35, which has eroded so many attempts higher. I suppose we now have to look towards the June 2018 high once more at 32.20, especially on a consecutive closing basis, as overhead beyond this, we don't really have that much until the April 2018 high at 33.02. But really not until the congestion area 33.29 to 33.39, made up from the 50% Fibonacci line, the March 2020 to March 22 move at 33.29, and the December 22 high at 33.39. LME 3-month 10. Over the last 2 and a bit weeks, nearly 3 weeks, we have been testing, penetrating, and trying to choose actually, whether to stabilize below or above the dark blue highlighted neckline extension for the October 23 to January 24 reverse head and shoulders bottom, which is currently at 28.715. This support is important. Back between mid-July to mid-August, prices based just ahead of this dark blue neckline, in reality basing itself for the most part down at the congestion between 28.835 to 29.005, containing the July 2011 high at 29.005, and back then the highly important slowly rising long moving average, currently 31.190. We also saw back then the dark blue neckline and the long moving average aligning with the 50% Fibonacci line of the March 23 to April 24 move, down at 27.330. All these slowed, stopped, and if not tested, then influenced the market, turning the market higher. The following pushback up became stuck in what I can best describe as an accidental congestion area overhead, created by the combination of what was the medium moving average, currently at 31.60, the short medium moving average, currently at 31.190, the 50% Fibonacci line of the March 20 to March 22 move at 31.845, plus the neckline of the thin and tall April-based head and shoulders pattern. Yes, that one. That's currently at 32.040. This quagmire lasted more or less until 3 weeks ago, when prices broke down through what looks like the bright red neckline, currently at 31.310, of the uneven August to November head and shoulders top. This bright red neckline is closely aligned with the long moving average, and I said about this long moving average 6 weeks ago, and I quote, "This is a key level," and it asks the questionist market whether it will bounce up from it as it did in late July and early August, as well as to a certain extent back in early September, or will it break it and test the late July based congestion between roughly 28.835 to 29.005. There is a lot of overhang in this market, so if it does break, then it may reach down to the previously mentioned neckline extension for the October 23 to January 24 reverse head and shoulders bottom. End of quote. Well, since that time 6 weeks ago, that is just about what the market has done. I said the following 3 weeks ago when I was actually forming my commentary at the time, and I quote, "Prices broke down through it with a vengeance, punching down not only through the gold long moving average, but also the July 23 high at 32.05 and the next congestion at 29.880. This move lower has prompted me to look at the whole August to date action as a possible head and shoulders top pattern with a neckline that is just below the gold long moving average. Now this move lower being just today is not as yet confirmed, but because of the size of the break lower, I feel obliged to at least give some potentials for any move below the proposed head and shoulders top pattern. Thus the primary potential will be down to the 29,030 zone, for secondary harder to reach potential down in the 27,170 zone. End of quote. Late 3 weeks ago, prices reached the primary potential, and then last week we reached down to within a few dollars, down to 27,200, so just $30 off my secondary target zone. Well, enough for me to call it achieved. We now wait and see if prices will stabilize below the dark blue neckline. Whilst this is happening, I'd like you to contemplate the following. We are on the verge of a possible bow tie formation, made up from the declining short medium and medium moving averages and a flatlining long moving averages. Now ideally, I'd like the long moving average to be heading lower, but it's not a perfect world, so we have a little uncertainty in there. But it looks good, and it will likely happen this week with a bearish tint. Additionally, it's worth now thinking about the possible volatility we may have 15 to 20 sessions after the crossover actually happens. All this is now something to very much be thinking about.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.